Hey, welcome to Retirement Made Easy. Are you invested in a target retirement date fund in your 401k? Today I'm going to give you 5 reasons why I'm not a big fan of target retirement date funds and why you might consider investing your money differently. And stick around to the end because reasons number 4 and 5 are going to absolutely blow your mind. So let's get right into it. So reason number 1 is investing your money, your life savings in a target retirement date fund. It's a cookie cutter approach. It's just based on your age. What it says is that everybody near your age needs to be invested exactly the same. And that target retirement date fund, let's say it's a 2025 target retirement date fund, and you're near your 65th birthday, because that target retirement date, it's in intervals of 5 years. You know, for example, 2020, 2025, 2030, 2035, so on and so forth. And that is the closest year to your 65th birthday, which they deem your retirement age. And so what it assumes is everybody that's near your age gets invested exactly the same. It does not take into account your appetite for risk, your unique goals and preferences, maybe income that you might need from your investments or growth expectations. None of that is considered. It is basically saying that anybody near that age, your age, gets invested exactly the same. So the idea of customization is tossed out the window. Again, it's a very, very cookie cutter approach. Can you imagine if you went to a car dealership and you said, hey, I'm looking to buy a new vehicle. And they said, okay, how old are you? And you said, I'm 65 years old. And they said, great, this is the vehicle you get. It is a white Toyota Corolla. Everybody that's 65 gets a white Toyota Corolla. And you said, well, what about my preferences? What about, maybe I need 4-wheel drive, or I'm going to be towing something, or I'm looking for fuel efficiency, or maybe I want an electric vehicle. And they said, no, every 65-year-old gets a white Toyota Corolla. Can you imagine? Or let's say you went to a restaurant and the server came up to your table and said, how old are you? And you said, I'm 65 years old. And he or she said, great, you get a salad with a steak and a baked potato. And because you're 65, that's what you get. And every other 65-year-old, they get the exact same thing. It doesn't take into account food allergies or preferences. Maybe you're a vegetarian and that steak wouldn't work for you. What about a drink? Maybe you wanted a non-alcoholic drink and that steak and baked potato and salad only came with a beer or a glass of wine. You get my drift here. So the idea that just kind of going with a cookie cutter approach for your life savings, it blows my mind. And I think personally that you can do better. I'm not saying that you might not have decent results with a target retirement date fund. I'm just saying I think taking into account your specific unique goals, preferences, appetite for risk, I think you can do better. And reason number 2 is when it comes to target retirement date funds, the brand behind the target retirement date fund, and we all know these different mutual fund companies and life insurance companies that offer retirement date funds, there is no standard of excellence. And what I mean by that is, and I have reviewed dozens and dozens of target retirement date funds, just because you're invested in the 2025 target retirement date fund, that fund might be invested differently than a competitor's target retirement 2025 fund. The expenses might be higher. The holdings within the target retirement date fund might be different. For example, if your neighbor worked for a company and in their 401k, they were also in the 2025 target retirement fund, their fund might be a lot better. It might have better returns. It might have lower costs. It might be managed differently based on what's written in the prospectus that's put out by the specific mutual fund company. So target retirement date funds differ from company to company, and you don't know whether your target retirement date fund is below average or above average. So your results will vary depending on the provider that offers your 401k and who manages that specific target retirement date fund. And reason number 3, while I'm not a big fan of target retirement date funds, is people don't understand them. They don't understand how they work. They don't understand what they own. And so it's hard to gauge whether they're appropriate for someone if they don't know what they own. When I ask somebody, hey, can you explain how you're invested in your 401k? And they might say, well, they do it for me based on my age. And I kind of know, well, they're probably in a target retirement date fund. And I ask the person, can you explain how they're managing that target date fund? And the person kind of says, no, I really can, or they come up with maybe a vague answer. It's kind of like asking somebody, explain to me how a microwave works, or explain to me how a zipper works. People can't do it. So target date funds, in my opinion, they're very ambiguous how they work, and people can't explain how their money is being invested. And this is your life savings here. We need to feel confident and comfortable with how our money is invested and how it's working to help us reach our financial goals. And reason number 4, and this is a big one here, I'm going to show you a sample target retirement date fund and how they vary and how they change over time from as you get older and closer to retirement. But also, I'm going to show you one of the big reasons or big disadvantages in my eyes for target retirement date funds. So let me share my screen. Okay, so this is a sample, and I have removed the provider of this target date fund, but you can see the 2030 target date example here. You can see they have 36.8% invested in the total US stock market index, and then they have 25% invested in the international stock market index. So a little less invested international than domestic in the US market. And so combined there, you're 61.8% in stocks. Now, some of those are US stocks. About 40% is international stock. And then you look at, okay, the difference down here, they have bonds. They have, in fact, 26.9% of the account is invested in the US total bond market index, and 11.3% is invested in the international bond market index. Now, this is for someone that's 5 years away from retirement, so assuming they're close to 60. And you can see, okay, then let's imagine 5 years goes by, and now that 2030 fund is now gradually becoming more and more conservative, meaning it's moving money out of stocks and into bonds or fixed income. And so what I did is I just looked at a 2025 target date example, same provider here, but you can see the change that has occurred over this 5-year period. Now the exposure to the US stock market index is now decreased 6%. So now they're only 30.8% in the US stock market index. And the exposure to international stocks has declined 4%. So we've now got 10% less in stocks, and that has gone into the US bond market index. That's increased 1.7%. We've increased our exposure to international bonds based on that index 1%. And this short-term inflation protected index, we've seen an increase of 7.3%. So what's really, really interesting about this is in a 5-year period, now we're closer to retirement, we're saying, okay, automatically this fund is now more conservative because we're 5 years closer to retirement. In fact, we're on the doorstep of retirement now. And fast forward, you would still stay within the 2030 fund, but it just automatically becomes more conservative. Now, one of the big downfalls to this that I see is this is still a heavy exposure to international stocks. At this point, you are invested 51.8% in stocks, and 40% of that, or 21% of the entire account or mutual fund, is in international stocks. And so, in my opinion, this is a heavy concentration in international stocks. And what I want to show you next is how the US stock market index has performed over the past 15 years versus the international stock market index. And so in my opinion, and a lot of other fiduciary financial planners out there would say, gosh, this just seems like a heavy concentration invested internationally in international stock markets. And this is a characteristic that is very, very common in target retirement date funds. They tend to heavily weight the amount that's invested in stocks overseas into the international markets. So I want to show you that next. So what I'm going to show you here is I'm comparing from January of 2010 to summer of 2025. So this is the past 15 years. I compared the US stock market index with the international or ex-US stock market index. And so going back, what this shows is $10,000 invested at the start of 2010, 15 years ago, what each would have grown to. So if you put $10,000 in the US stock market index versus the international stock market index. And you can see as I fast forward here to the far right that $10,000 invested in the US stock market index by summer of 2025, just 15 years and a couple months later, it had grown, that $10,000 grew to almost $70,000 versus the international stock market index had only grown to $23,783. So not even 24 grand. So this is a wide disparity here between how well the US stock market index has done over the past 15 years versus the international stock market index. It has been a pathetic return for the international stock market index. So why are we investing of everything that we're investing in stocks? Why are we putting 40% into the green line here, the international stocks? It just doesn't make sense to me. And so if I scroll down, I will show you the return, the average annualized return for the US stock market index is 13.36% during this period versus 5.75% per year for the international stock market index. It's less than half, way less than half. And then if I keep going here, what I'll show you is the rolling 3 and 5 year periods. During the last 15 years, what this does is it compares the US stock market index versus the international stock market index. And over a rolling 3 year period, there is not one period during the last 15 years where you would have been better off in international stocks than you would have been in US stocks. And then if I go to the 5 year rolling period, you cannot find one 5-year rolling period where you would have been better off in international stocks than you would have been in US stocks. So it just blows my mind why these target retirement date funds are so heavily concentrated in international stocks. Now, what about international bonds and US bonds? This is another thing. So if we look at our 2025 target date fund, we can see we have almost 30% invested in US bonds. And then we have about 12.3% in this particular target date fund. And as I said earlier, all target date funds are built differently, but in this particular one, a little over 12% is invested in international bonds. So how did they do over the past 10 years? Just as an example, because you can see combined, we've got over 40% in bonds in this target date fund. So how did they perform? So that's what I want to share with you next. So we have the total US bond market, and then we have global bonds, which is the international global bond market index. And so we're looking back just 10 years to 2015, and we want to say, okay, $10,000 invested in each. How much did that grow to 10 years later? And you can follow along here. And our US bond market index grew from $10,000 to $11,723, whereas the international bond market index only grew to $11,087. So that's a very, very low return over a 10-year period. If I go down, it'll show us during that period, 1.53% on average is what the US bond market index returned versus 0.99% during the same period for international bonds, the international bond market index. So these are very, very low returns. And again, these target retirement date funds have a large percentage in the US stocks and international stocks, but also US bonds and international bonds. And as we get older and older, they put more and more into the fixed income or US and international bonds. It becomes more conservative. So the last point I want to make, reason number 5 why I'm not a big fan of target retirement date funds is they don't have flexibility. So they're going to change as you get older, they're going to automatically shift more from stocks to more into bonds. But as the economy changes, as interest rates go up or down, as inflation goes up or down, as the dollar rises or it falls in value, as commodity prices go up or down, it doesn't change the strategy. So those opportunities that might exist out there in the economy as far as investments, they're not taken advantage of. You're sticking with the program, and it is a very, very static approach to investing your hard-earned retirement dollars. And so there's no variation, there's no tactical approach here. It is by the book, by prospectus. So I hope these 5 reasons why I'm not a big fan of target retirement date funds have really been a learning experience for you, and maybe you should consider doing something different. I'll see you next time, and remember, always dream big. Hello, I'm Greg Gonzalez, founder of RetireStrong Financial Advisors. If you want to see more videos like this, please like and subscribe. And if you want to learn more about how we help people plan for a successful retirement, visit our website, RetireStrongFA.com.